Hello and welcome to our special year-ender series, Indian Economy in 2025. And today we have a very special guest. We have Neelkanth Mishra, the Chief Economist at Axis Bank. He has just published the bank's outlook for India in 2025. And remember, he's important. He's also a member of the Prime Minister's Economic Advisory Council, besides being one of the leading equity strategists in the country. Neelkanth, thank you very much indeed for joining us.
Thank you for having me.
Well, first up, let me start with domestic. Though the world is going to cast its own shadows, I noticed that your FY26 forecast is 7%, highest on the street. Now, when you look at the Q2 numbers, 5.4%, you kind of feel that we are not in the 7 league. We are probably in the 6.5 league. What makes you so confident of 7?
Well, the extent of fiscal and monetary tightening that we saw was extreme. So just to give you perspective, generally, the central government incurs about 62% of its fiscal deficit in the first half. This year, it incurred about 29%. So there was a 33% slippage. And on a 4.9% of GDP worth of fiscal deficit, that means there was a 1.6 percentage points of GDP of fiscal consolidation squeezed into just 6 months. That's a very strong phase of tightening. Secondly, you saw a 4.5-5% decline in the credit growth. And that was because first there was a quantity of money problem, then perhaps with the regulator talking down loan deposit ratios, which we have discussed on your show earlier as well. If you see a 4-5% points of decline in overall credit growth, obviously the economy is going to slow down. Now, as we start to see the recovery, as the government spending picks up, I think these tailwinds will last will build momentum into FY26. We think that the CRR cut was very necessary. I think it helps bring sustained money into the economy. So as you know, it's base money, it is high-powered money. 1.16 trillion could actually become 5 to 6 trillion over time. And this should suffice to bring credit growth back. We also expect, this is not yet there, and of course our 7% growth forecast is predicated on that there should also be, there's likely to be, in my view, some more macroprudential easing so that credit growth starts to bounce back up a bit.
Okay. Now, I take your point that we had an extraordinary loss of liquidity and fiscal curbs. But let me come to even the latest data we are getting. Look at the Godrej consumer numbers. That's not looking, it's not as if something has picked up now despite the increase probably in fiscal spending. And secondly, the unsecured loans. I can understand MFI loans. Maybe they are, victims of seasonal variations. But unsecured loans, how many banks? IndusInd Bank showed us, RBL, IDFC a bit. I mean, if I remember, there were 4 or 5 banks, Kotak as well. Unsecured loans, two-wheeler loans are going down. That there is an income problem, isn't there, if FMCGs are not being bought?
See, when overall credit growth, overall economic growth slows down to 5.4%, though we must be very careful with these quarterly GDP statistics. I think there are more estimates than measurements. But it was very clear that things had slowed down. So if things slow down, obviously loans will go bad. See, remember that if you were expecting 7% growth or the equivalent of income growth that comes from 7% real growth, and your growth is 1.5% lower, there will be large segments of the population which are struggling for liquidity. What then happens is that everyone pulls off their hands. So as you know, people don't go bankrupt because of insolvency. They go bankrupt because of illiquidity. And then liquidity dries up, and then even the individuals or the entities that were not supposed to go belly up, they start going belly up. So now, once the overall economic momentum picks up, that's the best cure for the challenges of bad lending. But remember that the unsecured personal loans and MFI, I think there were excesses starting to happen at the fringes. And so some kind of correction was needed. But I think what has happened because of the attempt to control lending in those segments is that a much broader credit slowdown has been engineered. I mean, there's no reason why, for example, mortgage growth should have been slowing down. So as those start to pick up, I think you will see much better momentum. One final point on consumption. Remember that this is likely to be an investment-driven recovery. So investment to GDP is likely to keep going up. And when that happens, so even if your GDP growth is 7%, your investment growth may be 8 or 9, maybe in 10%, and your consumption growth could be 4.5 to 5%. Within that, there will be a divergence. At this stage of development of the economy, inequality is bound to go up. And therefore, the segments like FMCG may only see 3% growth. And some of the segments which cater to the higher income households may see faster growth. So this is not at all evidence that overall economic growth cannot be strong.
Okay, you mean there could be a bit of a K-shape in this and we could still grow at 7%. Now, you know, your arguments convince me that we are not a 5.4% category. But I'm not still convinced we will catapult over this 6.5% mark to 7%, because on hindsight, it appears that we were able to manage that 7% plus for 3 years because of very large fiscal largesse. Now, that is going to come down, isn't it?
No. So the theory says that an increase in fiscal deficit supports growth. Yes. A decrease in fiscal deficit is a headwind to growth.
Yes.
So we went from, so forget about the 9.5 to 6.9. See, that
was an unusual one.
Yeah. Unusual thing, right? But 6.9 to 6.4, 6.4 to 5.6, 5.6 to 4.9. These are substantial reductions in fiscal deficit. So I think the economy was doing fine as it opened up and as people started to spend or as the economic activity normalized, and able to withstand the fiscal consolidation. But if you do the equivalent of 1.6 percentage points in 6 months, there is bound to be an impact. The economy could not withstand that much. Now, think about it this way. In the next 6 months, as the government catches up, and October has already been a pretty good month in terms of the pace of fiscal easing. Yeah. And so you may actually end up with a much lower pace of fiscal deficit than you had in the first half. Okay. And which means that there will be an impetus to growth. And you are starting to see, you must have seen that, car registrations have picked up in November. There is an improvement in some power demand. There is improvement in the number of launches of real estate. So there are signs that October was the bottom, and we are starting to recover. I am 100% with you that there will be a debate and a discussion on whether, when we rebound from here, we land up at 6.5 or 7 or 7.5. I do think that our trend growth is 7. So if we don't artificially slow ourselves down through policy measures, I think we should be able to get back to 7%.
Okay. I'm not very sure that some of these slowdown measures will go away. For instance, overall fiscal deficit is also designed to go down up until 4.5%. And we have a problem of incomes. We've probably created jobs, but we have not created jobs with high incomes. So are you convinced about consumption? And will people invest in capex without consumption? Both those questions together.
Yeah. So see, GDP growth is income. I think what you're worried about is
low incomes.
Growth, low income growth. See, that's a political problem. And I think it's a very serious political problem. If we don't solve it, our reform momentum will have to be reversed. A lot of other things will start to happen. But it is a political problem. It's a redistribution problem. It is not an income problem, income generation problem. Because if you're growing at 7% real and most likely 11-12% nominal, that's a very strong pace of growth. Now, how you're distributing it actually becomes an issue. At this stage of development of economy, where labor is generally in surplus and capital is the constraint, the labor share of income, because labor has lower bargaining power, it generally tends to fall. And that is what you are seeing reflected in these things. So the capex recovery that we are talking about is a reversal of the slowdown that happened between 2012 and 2021, where of the 7% points decline in investment to GDP ratio, 5% points came from real estate. And I would say 1.5 to 2% came from the decline in investments in new power capacity.
Okay.
And the rest came from mostly from areas which are inputs to real estate, like metals, like cement, like construction machinery. Now, if if housing construction really picks up, and I think that policymakers should actually focus on that, I think the investment cycle will be up and running.